Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've chosen the time period from 23rd December 2019 to 5th January 2020. And the articles that I've chosen are from Business Line, Hindu, Business Standard, Indian Express, Live Mint. Let's begin the discussion. The first article is related to the concept of a waiver of MDR. MDR stands for Merchant Discount Rate. Now, some of the very important points that you need to understand this particular article are: one, concept of merchant discount rate; second, concept of UPI, Unified Payments Interface; and the third one is concept of RuPay. Very recently, Government of India has announced that from January 2020, the MDR that is applicable on transactions involving UPI and RuPay will be waived off. Now, what is the concept of the RuPay, concept of UPI, and concept of MDR? Now, before understanding the concept of MDR, please understand, whenever you make a transaction using, let's say, a debit card or a credit card, the basic system is, here is a bank which has issued a card to you. Using this particular card, you'll make a transaction, let's say, at a retailer. For example, a petrol bunk. Now, this particular card is basically issued by one of the companies or fintech companies such as RuPay, Visa, or Mastro. So, usually you'll see in the card, one of the names of these three companies will be printed. Now, apart from this, another very important stakeholder in this particular transaction is the point of sales machine provider, or in simple terms, there is either a fintech company, financial technology company, or a bank which has provided the point of sale infrastructure to this particular retailer. Now, let's say hypothetically, I've gone to a petrol bunk, I've refilled the tank using 500 rupee. Now, once I make this particular refilling, I'll have to make the payment to the petrol bunk owner. Now, in this particular transaction, let's say the MDR applicable or merchant discount rate applicable is, let's say, hypothetically 10%. Again, it's a hypothetical number. What this particular MDR here basically means is, for having provided this particular infrastructure for the retailer to conduct the transaction through either the debit card or through either the credit card, the companies will impose a certain charges. This particular charge, which is imposed on the trader or a retailer for using this kind of an infrastructure to conduct transactions, is called as a merchant discount rate. Now, earlier I have mentioned, let's assume that MDR is 10%. If this particular retailer is accepting the payment of 500 rupees using a debit card, then out of this particular 500 rupees, the retailer has to pay 50 rupees, which is 10% of 500. To which company or to whom? Basically, this particular 50 rupees, that is MDR, will be distributed between one, the bank which has issued the card; second, the company which is basically a financial intermediary, either RuPay, Visa, or Mastro; and third, the company which is going to provide the infrastructure facility to the retailer, that is, let's say, a fintech company or a bank. This particular MDR will be distributed amongst these three particular stakeholders. So, I'll repeat the concept here again. MDR, merchant discount rate, is the charge that is imposed on the retailer or on the trader who has used the infrastructure for conducting the transactions. This concept is called as MDR. Now, what has happened? In the recent times, to promote the concept of a digital transactions, Government of India has announced a waiver of MDR on the transactions which will be done using UPI or using RuPay cards. Now, what is UPI? UPI basically stands for Unified Payments Interface. Now, under this particular concept of UPI, which has been developed by NPCI, National Payments Corporation of India, you can give or you can transfer funds from account to account, or you can receive funds from account to account. Now, basic concept here is UPI is nothing but it's a immediate payment services which has been provided by NPCI. Under this particular concept, I can transfer funds from my account to another account. using a concept of virtual ID, or I can receive or I can request for funds from one account to another account. For example, if I want to send funds from my account to your account, all I need is your virtual ID. And please understand the importance of creating a virtual ID is whenever I want to transfer the funds to you. Earlier I used to ask what is your account number, what is the name of the account holder, what is the IFSC code, so on and so forth. But under the concept of UPI, all these particular details will not be required. All I need is what is your virtual ID. And once I get your virtual ID, I can simply transfer funds from my account into your account. This is called as a push transaction. Under UPI, push transactions are allowed. But apart from this, I can also request funds from you using the same concept of virtual ID. These kind of transactions are called as pull transactions. So remember this, in case of a UPI, I can have push transactions as well as pull transactions. And under UPI, I can transfer the funds 24/7. Throughout the day, I can transfer the funds from one account to another account. The cost of transactions with the waiving of MDR is expected to come down. These are much safer in form of transacting from one account to another account. So Government of India, in order to promote the concept of a digital transactions, has announced that whenever a transaction is done through UPI or usage of UPI, the MDR which is applicable on these particular transaction will be waived off. Second, whenever the transaction will be done using RuPay also will be waived off. Now what is RuPay? RuPay basically stands for rupee payment. It's a basic financial intermediary or a financial transaction intermediary which will facilitate the transactions between the trader as well as the customer, or between trader as well as the bank. What usually happens is, let's say hypothetically, I've purchased certain items from a retailer. I will use my card. Now once he swipes or dips this particular card, the information from this particular POS will be transferred to this particular concept of RuPay. Then using this particular information, they will send it to the bank, allow for the withdrawal of the money from the bank account. So RuPay will facilitate the transaction between the retailer as well as the customer or a bank. Both RuPay as well as UPI have been developed by National Payments Corporation of India. Now, with the announcement of Government of India, what has been the issue discussed in this particular article? Now, already I have mentioned this. It is not just the NPCI which is involved in these kind of transaction. There are also financial technology companies or fintech companies which are involved, banks which are involved in these kind of transaction. Whenever these kind of digital transactions are happening, the stakeholders in the system, that is the bank, the financial technology companies who are providing the infrastructure, will gain certain incentives or will earn certain incentives as a part of the MDR. Now with the announcement of Government of India that MDR will be waived off, it is expected that these particular stakeholders in the system will not be earning any kind of an incentive. That is the reason they are asking Government of India to provide certain relief to them in the form of payment of the MDR. But Government of India has denied or has basically rejected this particular proposal of providing any kind of relief to these particular companies. Having said so, please understand, various experts are stating that with this kind of an announcement of Government of India, it is going to affect the infrastructure which is going to be provided for these kind of digital transactions. That is, in the process of promoting the digital transactions, Government of India may end up harming the infrastructure or may have an impact on the issue of RuPay debit cards by the banking sector. Now, what is the concept here? I'm a bank. Earlier, I was issuing cards where the intermediary is RuPay, where the intermediary is Visa, where the intermediary is Mastro. Now, Government of India says once I issue RuPay debit cards, I will not be getting any kind of incentive in the form of a MDR payment. Now, since this particular incentive is not provided to me now as a bank, I will not have any kind of orientation or incentive to issue the RuPay debit cards. It may affect the issue of debit cards of RuPay. That has been one issue. Second one, now various fintech companies such as Google Pay, Phone Pay as well as Paytm have entered into rural market and have provided the infrastructure using which UPI transactions have been conducted. With the announcement of Government of India that this particular MDR will be waived off, this kind of expansion of infrastructure will be affected. And various experts have already stated that it might so happen that these particular companies may start withdrawing the POS or point of sales terminals or the infrastructure which has been already provided, because now the MDR has been waived off by Government of India. These are some of the issues which have been raised in this particular article. Now, based on this, let's have a look at some of the questions. Consider the following statements. RuPay and UPI are owned by NPCI. Yes. MDR is decided by RBI. Yes. Both the statements are true. Right option will be option C. Both are correct. Government or RBI has announced reforms in the following to promote digital transactions. We have already seen that Government of India has announced reform in the form of a waiver of the MDR for UPI as well as RuPay debit cards. Now, what is the concept of NEFT and RTGS, and what reforms, if at all, have been announced by RBI or Government of India in the recent days to promote the digital transactions? To understand this concept, let me use a slide here. I've basically compared the three other forms of transaction methodologies or payment methodologies that can be used in case of the banking sector. One is NEFT, second one is RTGS, and the third one is IBPS. NEFT stands for National Electronic Fund Transfer, RTGS stands for Real-Time Gross Settlement, IBPS stands for Immediate Payment Services. Now, the minimum transfer of amount that has to be done under each of the types of transactions are, in case of NEFT, you will have to transfer a minimum of at least 1 rupee. In case of RTGS, it is a minimum of 2 lakh rupees, and in case of IBPS, again it is a minimum of 1 rupee. Now, what is the basic difference between NEFT and RTGS? In case of NEFT, usually the transactions are cleared in the form of bulk transactions or in the form of the tranche of transactions. That is, once every half an hour, the group of transactions under NEFT will be cleared by RBI. That is a precise reason. In case of a NEFT transaction, there is a time lag between at what time you actually transfer the funds and at what time the fund will get transferred into the beneficiary account. Usually the time lag will not be more than half an hour. So in case of NEFT, the time lag is present, whereas in case of RTGS, as the name represents, the transfers will happen in real time. That is a precise reason. Earlier, the charges on NEFT were lesser compared to the charges on RTGS. Now, what has been the announcement in the recent times with respect to these particular types of or modes of payments? Very recently, RBI has announced that rather than limiting the time period for the transactions under NEFT, the NEFT facility will be available throughout the day. That is 24/7, the NEFT facility or window will be open now. IBPS as it is already available for 24/7, and RTGS is between 7 AM to 6 PM, and RBI wants to make this also 24/7. And what is the maximum amount of the funds that can be transferred under each of the heads? In case of NEFT, there is no limit on the fund transfer. In case of IBPS, the limit is 2 lakh rupees. In case of RTGS, if you are a retail customer, the limit will be 10 lakh rupees. And if you are a corporate customer, there is no absolutely limit on this particular value of the transaction. What about the charges applicable for NEFT, RTGS and IBPS? In case of IBPS, the charges will vary between 5 rupees to 15 rupees. In case of RTGS, RBI has announced that charges will be waived off from January 2020, and NEFT, no charges will be applicable from January 2020. All these reforms have been announced very recently by RBI in order to promote the digital transactions. So remember all these particular terms. UPSC might ask these particular questions in the UPSC prelims. Now, based on this particular information, let's solve the question. The government or RBI has announced reforms in the following to promote digital transactions. We have already seen that in case of UPI as well as RuPay, Government of India has waived off the MDR, and RBI has announced recently the waiver of charges on NEFT as well as RTGS also. So in case of all the four, either the government or RBI have announced reforms to promote the digital transaction. So the right option will be option D, 1, 2, 3 and 4. Next question, consider the following statements. Transactions in UPI can be done between 7 AM to 6 PM. Wrong. It can be done 24/7. Facilities available for 24/7. UPI provides for push and pull transactions. Yes. You can request for fund transfer. You can provide for fund transfer, or you can simply transfer the funds. Both the types of transactions are available in case of UPI. So the right option will be option B. Consider the following statements. RuPay was developed by NPCI. Yes. NPCI is a Section 8 company under the Companies Act of 2013. Now, what is Section 8 company? These are the companies which are set up for not for profit purposes. and NPCI is a not-for-profit company. So yes, NPCI is a Section 8 company, and some of the books will also mention a concept of Section 25 company. Please understand, earlier we had a Companies Act of 1956. Under the ambit of Companies Act of 1956, those companies which were set up for not-for-profit purposes were set up under Section 25. But with the change in the Companies Act, that is from Companies Act of 1956 to Companies Act of 2013, rather than calling them as Section 25 companies, we are calling them as Section 8 companies. So second statement is correct. NPCI is an umbrella authority for all the retail payments. It is also correct. So the right option will be option C. 1, 2, 3 all are correct. The next article is related to non-essential imports. Very recently, Government of India stated that they want to impose certain restrictions or create certain standardization which will control or curb the import of non-essential commodities or goods into the domestic market. Now, what is this concept of a non-essential commodities? Please understand, the imports are usually divided into essential imports as well as non-essential imports. For example, crude oil. Can you expect Indian economy to grow without the import of crude oil? Not possible. India is heavily dependent on the import of crude oil. In fact, as per the recent surveys, it has been shown that 85% of the demand in the domestic market for the crude oil is satisfied through the imports itself. So can you expect the GDP to grow without importing crude oil? It is not possible. Hence, these kind of commodities which are essential are referred to as essential imports. But on the other side, imports such as furniture, the plastic commodities, toys, sports commodities, so on and so forth are usually classified as non-essential imports. Now, what is the concept here? In the recent times, it has been seen that the trade deficit between India and China has kept on increasing or has reached to a very high level. What is this idea of a trade deficit? India exports goods or commodities to China and also imports commodities from China. The value of India's exports is lesser than the value of imports from China. How much? As per this particular article, the value of imports from China are $53 billion higher compared to the value of exports from India which are entering into China. And this particular trade deficit is a cause for concern for Government of India. And the value of non-essential imports which are coming into India are to the tune of around 4 trillion rupees. So Government of India in the recent times has announced that they want to impose certain restrictions or impose certain standardization measures which will help Government of India in curbing this particular idea of a huge amount of non-essential imports which are coming into India. And since we are going to impose certain restrictions or we are going to restrict these particular imports into India, you will not have any kind of a negative impact of these particular restrictions on the GDP growth rate. Apart from this, one more point which has been mentioned in this particular article is that Government of India is trying to introduce the concept of the standards in case of the imports. Now, as of the present situation, there are around 370 standards for imports which are classified or which are designed by Government of India. Government wants to increase this particular number from 370 to 5,000 standards. With increase in this particular concept of the standards, we are not only going to restrict the flow of the imports into India, we are also going to promote the domestic production which will help us export more and more into the international market. These are the two very important points which are mentioned in this particular article. Now, what is the impact of these particular imports? What will happen if I allow the imports to come into India? In case of the essential imports, I need them, so I need to import these particular essential commodities. But what about the non-essential commodities? More the import of these particular non-essential commodities, higher the outflow of the dollars from the domestic market into the international market. And whenever these kind of imports will keep on coming into India, the supply of rupees in the forex market will keep on increasing and I need to pay in terms of dollars. So I will sell rupees, purchase the dollars. Rupee will start depreciating, dollar will start appreciating in the domestic market. That is the second impact. Third, higher the inflow of these particular imports, the trade deficit is going to balloon. The current account deficit is also expected to increase. Because of all these particular concerns, Government of India wants to restrict the inflow of these particular non-essential commodities. And in this particular concept which has been discussed here, the Government of India is most worried about the imports which are coming from Chinese market into Indian market. And Government of India wants to restrict the inflow of non-essential commodities which are in the form of toys, plastic goods, sports items as well as furniture, especially from China. So this is the discussion provided in the article. Now based on this discussion, let's solve a question. Which of the following are the contributors for the decline of the current account deficit? Now please understand before solving the question, what do you mean by current account deficit? There's a concept of the balance of payments. Balance of payments represents a record of all the import transaction as well as export transaction done by one economy with the rest of the world. I'll repeat the statement. The balance of payments is a record of all the import transactions as well as export transactions which are done by one economy with the rest of the world. For example, India exports, India also imports. That is one type of a transaction. FDI will flow into India, FDI will flow out of India. Remittances will come into India, remittances will go out of India. All these kind of transactions are recorded under the concept of the balance of payments. This is important to record for a simple reason. At the end of let's say a quarter, at the end of the month or at the end of the financial year, you need to understand whether India needs to pay to the rest of the world or India needs to receive from the rest of the world. In case of the balance of payments, one of the very important accounts is a current account. And in case of the current account, if the expenditure side is higher than the revenue side, or in simple terms, if the outflow of dollars is higher than inflow of dollars, this particular situation is called as current account deficit. And India has a current account deficit. So question is, which of the following will have an impact in reducing the current account deficit? Let's solve the question here. 1. Restriction on non-essential imports. Yes, with imposition of restriction on non-essential imports, will the value of imports come down? Yes. If the value of imports come down, is there a possibility of a reduction in the current account deficit? Definitely yes. Second one, exports demand slowdown. For example, in the recent times, we have experienced there is a slowdown in the international market for goods as well as services. And when there is a demand slowdown in the international market, our exports will get affected. Our exports are expected to come down, and when our exports come down, the current account deficit is also expected to expand like this. So no, this will not lead to reduction in current account deficit. Third one, increase in exports. Whenever you increase the exports, the revenue side of the current account will increase. And when the revenue side increases, the current account deficit is expected to come down. So first point is correct. Third point is correct. Right option will be option C, only 1 and 3. The next article is related to minimum wage plan. Now please understand, in the recent times, Government of India, to rationalize the labor codes or labor laws, has basically taken around 40 labor laws and has tried to rationalize these particular labor laws into 4 codes. One of the very important codes out of these particular 4 codes is a code on wages. Now what are the important points related to code on wages? This particular code on wages will subsume some of the earlier pieces of legislations or earlier acts which regulated the concept of wages in India. For example, it will subsume the concept of or the act of minimum wages. It will subsume the bonus announcement act. It will subsume the fair wages act, so on and so forth. That is the first point. Second point, under the code on wages, Government of India will define what is the minimum number of working hours. I'll repeat the statement. Under the code on wages, Government of India will announce or will define what is the minimum number of working hours. And if a wage worker is employed or is working for more than what has been prescribed by the government, then overtime wages must be paid to this particular worker. That is the second very important point. Third very important point under code on wages is henceforth government or the central government will define what is the floor wage. Please remember this. The central government will announce a floor wage in certain circumstances, and the state governments will also be allowed to announce a floor wages in certain circumstances. For example, the wages in case of railways, wages in case of people who are working in oil fields, in mining sector, etc. will be decided by the central government. And wages in other sectors which are not covered under this particular list will be decided by the state government. Now, what do you mean by floor wage? Understand this. In case of the floor wage, the central government or the government is basically going to decide what should be the minimum wage. And once the government decides what is a minimum wage, all the sectors which are covered under this particular concept of a minimum wage will have to pay a wage which is at least this particular floor wage as decided by the government. Now, what if you are a state government which has already announced a wage which is higher than the floor wage announced by the center? Then you are not allowed to decrease your wages so that you can control your cost of production or so that you can control your outflow of wages. So the concept of a minimum wages or floor wages is that once it is decided, any sector which is covered under this particular concept has to pay wages which are at least the floor wage as decided by the government. Now here comes the point of contention. Presently, the minimum floor wage or the national floor wage is just above 170 rupees. And government under this particular concept of a wage code has announced that floor wages will be increased by 10%. The stakeholders in this particular system, that is the wage workers, are unhappy with this particular announcement of the hike. What they are demanding is much higher hike. And to add to this, there is already a panel recommendation under the Ministry of Labour which has recommended that the wages at the national level, that is the minimum wages, should be fixed at 375 rupees. So this is one contention. Second contention is the other side of the stakeholders, that is the employers. If the floor wage is increased like this abruptly to a very high level, then the wages which are paid by the employers will increase. And when wages paid by the employers will increase, the cost of production will also increase. Now the concern is this increase in the cost of production will always have a negative impact on the market prices and the demand in the market. But especially in the present context, when there is a huge slowdown in the domestic market because of lower consumption demand in the market, it doesn't make any sense to pay higher wages, which will lead to higher cost of production, in turn which will lead to higher market prices. So when the demand is already low, you should be able to increase the demand by lowering the prices, and demand will not increase if the market price of the commodities increase. So these are some of the concerns which have been raised by various stakeholders regarding this particular code on wages. As a result of this, despite being more than 5 months with the passage of this particular bill, Government of India is yet to notify the implementation of this particular bill. Especially the concept of the floor wage is very contentious and Government of India is moving very slowly on this particular code on wages. This is a point of discussion under this particular article. So based on this particular discussion, let's solve a question. Consider the following statements regarding code on wages. The code will replace a Payment of Wages Act, Minimum Wages Act. Yes, both will be subsumed or both will be replaced by this particular code. Under the code, central government and state government would be deciding the floor wages. Yes, it is also correct. If the employee worked overtime, he is entitled for overtime wages. Yes, this is also correct. So choose the correct option. The right option will be option C. 1, 2 and 3. All the statements are correct. The next article is related to the railways tariff announcement. Now please understand, in case of the railways, there has been a lot of discussion in the recent times. This particular discussion has been prompted by a CAG report, which has basically stated that the operational ratio of railways has crossed 98%. Now what is this particular concept? What has been announced by the government? Please understand this. In case of railways, there are two segments. One is called as a passenger segment and the second one is called as a freight segment. And in case of India, there is a concept of a cross subsidization in case of railways. Now what do you mean by cross subsidization? Let's say hypothetically, railways will incur a cost of 3 rupee to take 1 kg either of a passenger or a freight for 1 kilometer. All these are hypothetical numbers just to explain the concept of cross subsidization. Now, when the railways will carry 1 kg of a passenger for 1 kilometer, rather than charging 3 rupee, they will charge lesser than 3 rupee. And in case of the freight, when they carry 1 kg for 1 kilometer, rather than charging 3 rupee, they will charge more than 3 rupee. The logic here is, by charging higher in one revenue stream or in one case of the travel, the railways wants to generate higher revenues, which will be used to provide subsidies in the other segment of the railways. This concept is called as cross subsidization. Various experts over a period of time have been recommending to Government of India to look into this particular concept of a cross subsidization. Why? One of the very important issues that is plaguing the railways is that the freight is being transported more through the roadways rather than being transported through the railways. At the time of independence, around 70% of the total freight transportation used to be done through the railways itself. Over a period of time, this has kept on declining, and today the freight transportation through railways is only around 1/3 of the total transportation, whereas around 3/5 of the total transportation of freight is actually done through the roadways. Now, what is the issue with the transportation with the roadways? Whenever you transport using the roadways, one, delays are usually expected. Second, cost of transportation is comparatively higher. And third, emissions are comparatively higher. So what Government of India wants to do is basically attract more and more freight, or basically divert the freight rather than being transported to the roadways. They want to move it into the railways. But there are certain issues in case of transporting through the railways. And one of the biggest issue which is basically affecting the transportation of freight through railways is the cost of transportation. And because Government of India is following this particular concept of cross subsidization, freight transportation is costlier compared to the passenger transportation through the mode of railways. So very recently, Government of India has announced two very important reforms. One, Government of India stated that they want to look into the passenger tariffs under the railways. And they have announced that the passenger tariffs will be increased from one mode to another mode of railways, or from one type of travel to another type of travel in the railways. The rates or tariffs have been increased. The increase or the hike in the tariffs has been around 4 paise per kilometer in case of railways. But this particular hike doesn't cover the suburban travel or suburban railways travel as such. On the other side, Government of India has also announced that they want to cut the freight rates, so that they want to make it cheaper to transport freight through railways, and they want to attract more and more freight transportation, divert it from the roadways into the railways. So these are the 2 points which have been discussed under this particular article. Now initially I mentioned the concept called as an operating ratio, and I stated that as per a CAG report which was made public very recently, the operating ratio for railways is 98.44%. And the report also says that this has been the highest in the last 10 years. Now, what is the concept of operating ratio, and what is the issue with having a higher operating ratio? Operating ratio basically represents how much expenditure incurred to generate the revenues. And in case of railways, when this operating ratio is 98.44%, it basically means it incurs an expenditure of 98.44 rupees to generate revenues of 100. So basically the CAG report says that operating ratio for Ministry of Railways is very high, or Indian Railways is very high. And in the last year announcement of the budget, the Government of India had stated that they want to drag this particular operating ratio down from 98% to 95%. So these are some of the points which are discussed in this particular article. The next article is related to food inflation. In the recent times, retail inflation, which is measured in the form of consumer price index, has been moving upwards. RBI is supposed to maintain the inflation rate in the range of 4% with a bearance level of 200 basis points. In simple terms, they will have to ensure that inflation rate will either reach a maximum level of 6% or a minimum level of 2%. This concept is nothing but the concept of inflation targeting. But coming to the point at hand here, this particular article discusses one of the favorable outcomes or positive outcomes whenever there is a higher rate of inflation in the market. Now please understand, in the recent times, one of the reasons why inflation rate has been increasing is because of food inflation. And when I say food inflation, it simply means compared to the base, the market prices of the commodities of food have increased, as a result of which we are experiencing a food inflation. Now this particular increase in the food inflation will be a headache for RBI, will be a headache for Government of India, will be a headache for the households. But this particular article says when it is increasing in the market, or when the prices of these particular food commodities are increasing in the market, one good outcome or favorable outcome is that the farmers or the cultivators are going to earn better. Now what is the concept here? What is the connection? Very simply, here is a farmer, he has cultivated certain crop, he will sell it in the market through, let's say, a distributor who will sell it to a retail buyer in the market. Now understand this concept here. When the retail prices will keep on increasing, it is expected that the earnings of the farmers will also increase. Although various surveys have shown that the farmers are earning just a fraction of what the price is paid by the retail consumer. For example, as per one survey which was done by Mr. Ashok Gulati, it was stated that the farmers are paid only 25% of the final prices paid by the consumers in the retail market. Now what do you mean by this? A farmer sells it to a middleman sells it in the retail market. If the buyer in the retail market pays 100 rupees for this particular commodity, the farmer would have recovered or would have paid this particular commodity only at around 25 rupees. So this has been one of the concerns related to the concept of the APMC. But having said so, understand this very carefully. Higher the price paid in the retail market, higher will be the recovery of the farmer also. As per one of the survey which has been done by Mr. Ramesh Chand under the ambit of Niti Aayog, it has been proven that if the market prices increase by 10%, the farmers' earnings or incomes increase by 13%. So when inflation rate happens and it is negatively affecting the households in case of urban India, it also means the households in case of rural India, which are heavily dependent on the agriculture income, they are earning more. So whenever food inflation happens, it is not always a negative outcome. One stakeholder in the whole system is making more earnings. That is the gist of the article provided here. So these are some of the very important articles as well as some of the questions related to these particular articles for this particular week. Thank you. Have a good day.